Estate Investing Club. I hope you guys are having a great day, great week, wherever you are and whatever day it is for you. As always, on the podcast, it is Friday, so we're bringing that good Friday energy to you. This is going to be a good episode because we got two topics to discuss. We got affordable housing and hospitality. So if those are either topics that you guys are interested, or if either of those topics are topics you're interested in, this is the episode to jump into. We got Dennis Shapiro with us from SIH Capital Group to talk about it. Dennis, I'm excited to jump into this. Thanks for hopping on.
Gabe, thank you so much for having me back on. I know the first time was a great conversation, so looking forward to this one.
Yeah, I should say thanks for hopping back on. I always forget to call out when we have repeat guests. So if you guys, maybe you remember Dennis from about a year ago, he came on the show to talk a little bit about affordable housing at the time. We might jump back into that, or maybe we'll stick in the hospitality. Wherever the conversation goes, that's what we'll do. But Dennis, I told you before we got on here, we're sticking with the same format. We like to start with people's stories. So why don't you take us to the beginning of your story in real estate and just tell us how you got started and then how it's been going since then.
Yeah, I'll try to keep it quick in case that I said a lot of this stuff last time. So I started investing in 2012, literally got out of college, got recruited by the government, was starting to work, started to realize, hey, I need some tax efficient investment strategies here. So I kind of got into the world of LPs, kind of stumbled into it. It was definitely a unique experience because I came from more of the traditional background. I was investing in stocks since I was about 14, 15 years old. So I started seeing the benefits of the private investments because I got great appreciation on the stock side, but I never got good cash flow. So I started seeing the private stuff, and I think the first fund I ever invested in was like a nice debt fund that paid double digits. I was like, all right, this is great. I can't get one REIT or one dividend stock that pays like this, and there's no volatility in the price. This is awesome. So I started seeing the pros of it. But at that time, I was a happy government employee. Fast forward, I worked for the government for 12 years. In that time period, I went from doing one investments to doing a handful of investments to starting an investment club where I did 12 to 15 LP investments. And then from there, we kind of branched out and went into more of the operational side. So I don't know if you want to call it old school operator or not, but I started from the investment side. So I truly, when I connect with our investors, I truly understand where they're coming from because I was them. And then I've made the shift over to the operational side, and now we're full time. I left the government in 2022, basically working at SIH Capital Group, and now we have 2 management companies, 300 apartments, and we're going to have about 60 hotel rooms going forward. So we've grown a lot. We've gotten some really great people on board, which has been a real big difference maker. But in general, it's been it's been a 13-year pathway from one LP investment to a bunch of LP investments to GPs and to like a full-blown real estate company now.
Nice. Yeah, you don't often hear people taking that trajectory coming from the passive quote unquote investor, the LP side, where you're investing in other people's deals and then getting into, turning into an operator, a GP. But I mean, I'm sure it gave you a great perspective because raising capital is one of the most important parts of real estate when you're really trying to scale. And so you got into it with that perspective. You understood what they're looking for. You understood what keywords that would kind of pique their attention and get them interested. So yeah, I think that's a great start. And I like that you said you started an investment club. So was this club, I'm sure it was like a meetup kind of thing, and you guys got together to talk about what type of limited, LP deals that you're going to be investing in?
Yeah, that's exactly what it was. And club, I use the word club very, very loosely. It was literally me and 2 other guys that
Hey,
thought
we'll
these
count it.
private. Yeah, it was hard because I was going to barbecues, I was going talking to friends and family, and I was so excited. I was like, look, I could buy 1% of an apartment building. Like, this is amazing. Blah blah. I was in my late 20s at that time, and they didn't care. They're like, all right, I just got a brand new Benz. They didn't care about this. So when I found 2 guys that I could really, really connect with, it was an awesome experience. And then we leveraged the technology that was available. Like we have a Slack channel where we really got to dive in and really analyze these. And these 2 guys were very, very high level executives. And we really had a really interesting dynamic where One was super analytical, the other one was super tech based, and then and I was kind of putting everybody together with deals and finding deals. Ironically, that's kind of how my company grew later on. But that investment club was very much early inning because it was the ability to actually analyze a deal. And even if I think it's a great deal, we needed 3 people to sign off on it. Otherwise, you could end up creating a security if you do it the other way around. So we always had to get that buy-in. We always had to really talk through the deals. It was funny because one of the people was a really hard no, and one of the people was always a really easy yes. So when I found the deal, I kind of knew if I could mend the gap or whatever it is, and we learned a ton to that investment club. I wouldn't change a thing.
Well, yeah, and starting off investing in other people's deals, it gets you, it refines your ability to understand what actually is a deal. And so if you guys, you have 3 minds that you have to get together to come to an agreement, and you guys are each coming at it from a different perspective. You're looking at these deals, you're hashing them, making sure that it fits the criteria. And having gone through so many deals and refining what to be a deal and then bringing it over to the GP side, I'm sure was a huge boon once you decided to, go active and become an operator.
It was, and it's weird. It's the simplest thing that I remember that played like the most significant difference for SIH, like talking to an investor. So the good thing is, when we did the 12 deals, we probably were not refined enough, and we were like, all right, we were excited, and if they were on a podcast, if they had a big brand, we wanted to talk to them. We did all the wrong things when we first started. But what ended up happening is we got into a lot of deals with a lot of different operators. So we got a lot of different communications. So we got the monthly ones, we got the quarterly ones, we got the detailed ones, we got the no communication at all. And then we started seeing like the data of which deals. And to be frank, that 2018 is a tough time to lose money.
Yeah,
In commercial real estate.
That's perfect.
So there was this honeymoon.
You lose money, you're doing something wrong.
Where we thought we were like, oh my god, we're onto something big here, and then just reality was you were investing in lower interest rate moving market. But at the time, we learned so much, and I remember it was even things like I had follow-up questions on a webinar, and these guys were raising money so quickly. And I'm just going to generalize. I'm not saying any names out there, but this was a decently big name. And I sent this like really in detailed email about like, hey, I really looked into this deal and I had these 12 bullet points. I really wanted to touch base. No response. And I told myself, like, if I ever became an operator, and as cumbersome that may be, that isn't the correct way of doing things. So there was this like real like, hey, they on their website they're all about investor first, and then in reality when you deal with sending them an email or something like that. And I remember I had one investor on one of our first projects, and she heard me on a podcast, and she ended up asking me for my personal financial statements before she was willing to commit to the deal, and I never did as an LP, so I had to think about it for a second. Yeah. And then when I talked to her about it, she just very simply said, she goes, I just want to know if the deal goes bad, you have the means of really doing whatever is required. And you're not limping in on a network capability where that deal will overwhelm you if it goes bad. And I said, okay, that's that's very reasonable. And I actually kind of felt like an idiot because I never did that as an LP. And I was like, that's gold. I was like, why wouldn't you do that? The banks will ask for it. Now, you're not asking for their private information, but like a general overview of like who that person is financially is a very reasonable request. And I remember sending that back to her. And I think if I didn't go through the LP side, I might have turned around and said, that's not reasonable or whatever it is. But then like really having that LP like foundation, I just thought it was actually really smart. And I actually commended her, and I actually tell my other investors, like, when you have doubts, just ask for like a PFS. You'll learn a lot of stuff.
Yeah, no, that's completely understandable and really smart on her part. But I really like, you going through the LP side, you realize how important open and honest communication, consistent communication is, from the GPs to the LPs, just so they understand, even if something's going wrong, at least you're communicating with them if they're, and you're presenting the solution that you're coming up. If pipes break, whatever the issue is, if something happens that has a negative impact, and not keeping that to your chest, and being communicative with the investors is so important. I saw a video earlier, a YouTube video about that one guy, the internet influencer. I guess he raised a bunch of money to buy some Radio Shack and whatever other
Oh yeah, I
businesses.
know who you're talking about. Okay.
Yeah. But he wasn't telling investors anything. He kept saying that everything was great. It just makes you realize how important being open and honest in your communication is, and being consistent in your communication. So, awesome. So we've really touched on the raising capital, being, communicating with your investors. Let's talk about what you guys are actually doing out there in the field. Affordable housing, hospitality, two pretty unique niches. I'm most interested in hospitality because we did talk about affordable housing before. So let's actually start with affordable housing. Just give us an overview, and then we'll dip into hospitality.
Yeah, so affordable housing is our like bread and butter on SIH.
Okay.
And what we learned is when we started as LPs, there's that like traditional like value add deal in quotation marks where you're paying like a good size premium. You're going in there, you're renovating a few units. You hope to catch interest rates somewhat kind of declining, and then you're flipping the property. Like that's what 2018 to 2022 was really about, right? There was very rare that you see the refis, you see all that stuff. So when we got into the space, we started looking at those kind of deals, and then very, very quickly gravitated to affordable housing. And the reason why we gravitated to affordable housing is that there's a huge price disconnect between affordable housing and then value add. And I'll just give a quick synapse of what I mean by affordable housing, because there's a lot of different misconceptions about it. So the affordable housing segment that my company focuses on is the LIHTC properties. And LIHTC properties stand for low income housing tax credits. And what ends up happening is if you have a raw piece of land, the cost to build that raw piece of land up to a beautiful Class A building and like a brand new affordable housing building is surprisingly very, very similar. What's different is the finishing touches, right? Because you still need roofs, you still need the utilities built out, you still need windows, you still need all of that stuff, but you're going to go with the granite countertops versus the laminate, all of that stuff. So no builder in their right mind would take a piece of property that can support Class A and turn around and just make it affordable because of the goodness of their heart. So the government realized that, and what they do is they subsidize a lot of the cost through these credits to make it way more affordable and cheaper to incentivize these builders to actually build. And sometimes these builders, they have their portfolio, like they have Class A stuff and they have affordable stuff, and depends on location, they'll figure out which way they're going to go with it. But these are the builders, they do both actually. So it's actually really, really interesting. So what ends up happening is the government gives.
And real quick, what are, like, give us an example of the type of subsidies that are provided. Is it like a
It's
tax
finance.
credit? Is it like an actual amount that you get for development, or what is that
Yeah,
subsidy?
it's usually in terms of very, very favorable financing. Sometimes the financing is 0% interest for extended period. We're looking at a deal right now at the acquisition period, and in our pipeline right now, there's an active deal where the current loan is $3.2 million, and it's a 0% interest, assumable loan, and the annual debt service is $12,000 annual.
That's great.
So
Sign me up.
you get some crazy deals sometimes. And this is like
Is
a
it
90
variable,
unit
or
apartment.
is it fixed rate? Well, it's not
It's
even a
zero.
rate. I mean, but will it change over time, or do you have a balloon payment?
It has a maturity period of, but most of the time these municipalities will keep extending it as long as you're willing to keep it affordable.
Interesting. Okay.
So it's a very interesting market. But what ends up happening is the first 15-year period, a lot of developers will keep that property. That second 15-year period, that's where the magic happens, because a lot of their incentives are burnt off at that point. They still have to comply with the affordability restrictions. And then, so they look to sell at that point. And that's where a company like ours, we come in, we buy in that second 15-year period. So for example, we bought a 103 unit portfolio in Virginia at the end of 2024. We paid $36,000 a unit for it.
Wow.
Yeah, 36. So the replacement cost was
Doesn't really matter what metro that's in. That's cheap.
yeah, yeah, and it was in the Richmond MSA for one of the
Okay.
properties,
Yeah.
and
That's
the second property was in Lynchburg,
okay.
Virginia,
So a pretty
which
big one.
also, yeah. So there are actually two really good sized ones. So 30 something a door, and the reason why it's 30 something a door because the compliance period is extended into like it's an 18-year extended period. So what ends up happening is we are long term guys. We're not trying to go for a quick flip. So we go in with a business plan of 10 plus years usually.
Mm-hmm.
All my partners are in our 40s, so we have that
You got 10
window.
years.
We got 10 years, and we're getting a significant discount because we're willing to. So it matches our business plan, but they're going to give us a discount for it. So we really, really love this model because not everybody gets. You have to have affordable housing experience. That's why we built out our affordable housing property management company. You have to usually get approved by the state financing. So if it's Virginia Housing, it would be Virginia Housing Finance Authority, or PHFA for Pennsylvania Housing Finance Authority. You have to during the closing process, you have to get an approval letter because the state does not want to take back 50, 60. They don't want the PR of 80 affordable housing units going bust because that's a big, big PR issue. So
Yeah.
it's not like any syndicator can actually go out and buy these. And you need the prior experience, and you're going to get a discount if you're willing to hold long term. So those are the three things that we absolutely love about them. And depending on certain MSAs have been a little trickier. Some MSAs we go in there. I'm sorry, I'm using MSA as a code word that everybody should. It's basically that market, right? That market. Sometimes we go into a market and there's a waiting list that's a mile deep for these apartments, and sometimes
You mean for tenants to rent them or for?
Yes, for tenants
Okay.
to rent them. So we don't have to do any advertising, nothing. It's
Yeah.
literally like we go to the housing authority, we work with them, and we fill these units quick. Sometimes like in Virginia, we did not have the most amicable housing authorities. So we really got into more of the Google marketing there, and we filled up the units. But our average occupancy is 98% for these units.
Oh,
Yeah, we really we treat like a vacancy like cancer. Like we go at it. So it's a really cool model. It's really interesting. Like that's why I look at some of these value adds, and they're paying $100 a door for these things, and it's the same rents that we're getting for 36 a door. I was like, yeah, I'll stick to our model.
I'll hold off.
Yeah, they could stick to theirs. We'll stick to ours. Let's see in 10 years how things work out.
So a question that kind of pops into my mind. So I own mobile home parks, and which is kind of fits into the same category in the affordable space. And a lot of issues that you run into with that class of tenant is you get a lot of delinquencies, and I'm sure in the apartment space you probably have a little bit more wear and tear on the unit itself. What is management like for this type of asset?
So we have a high standard. So one thing I wanted to clarify is a lot of people think that like we're Section 8. We're not Section 8. What affordable basically means is that when we rent out that unit, they have to be in a certain area medium income. So for example, let's say that area,
A family making 60,000 has to be able to afford it.
Exactly. So some people do come with vouchers. Now that's the Section 8. Now when they come with vouchers, they can lose those vouchers if we report them. So if they're a bad tenant, there is a real, and those vouchers are very, very, it's like gold for them. They don't want to give them up. So we have a high standard. We don't play those games. Like we, in Ohio, our affordable house, they have a 3-day notice to quit basically. So if they don't pay their rent, they're getting the 3-day notice on the 7th or the 8th. So our delinquency across the board is extremely low. It's just about setting the culture, setting the right expectations, really because tenants talk to each other. So if you got a tenant and he hasn't paid rent for 2 to 3 months, and he's allowed to communicate that to all the other tenants, your delinquency is gonna skyrocket. It doesn't matter what ends up happening. But if you treat that one person as an example, that's gonna get around as well. That like, hey, especially like the most critical time with these buildings is the first takeover. It's once you take over, you have 45 days you really have like 15 days to set the culture that like, and you want to be fair, you want to be reasonable, but like we had one
Well, you
person.
just you make sure that people are following the rules. We did the same thing with a park that we bought recently, and there was just so much delinquency. People would pay months after, they'd pay in every 3 months they'd pay, and we stopped that by when someone was vacant or when someone was delinquent, we would send them the appropriate notices, and then we actually moved into the eviction process. And once we did that, everybody else figured it out, and delinquencies have been down. And so it's you just got to make sure and set the rules and then adhere to the rules, and everybody else will kind of follow suit.
Yeah, Gabe, a lot of it is just it really comes down to cost of capital, right? The seller who you bought from, his cost of capital was so low that if he makes 4 or 5 grand a month on rent roll, he's like, okay, that's a decent. Like I'm
Yeah,
okay
he was
with
in
it.
his 80s and he had no debt on this thing, and so he didn't care.
That's the common story. It's their dead row so thing. So who pays, whatever it is. A lot of them become friends with the people, whatever it is. But like when you come in and new sheriff town, and we get this a lot. Like you hear all the different stories, whatever it is. That's why we created the management company. Even though the owners are involved in the management company, they never ever respond to a tenant with their name, nothing. It is the management company, and then we have a legal division that handles the evictions. And if someone is delinquent and didn't go, at that point, it's out of the manager's hands. It's in legal's hands, and all of that stuff is there to basically protect the company and create these rules and standards that it's actually good for the community. That's how the community gets better, because it gets the people out that don't want to follow those rules. Let them go somewhere else. But it's okay to be the bad guy.
Yeah. So how you're looking for a very specific type of asset. It has to have had this this tax credit or this credit or government, I guess, government stipulation, whatever it is that you guys are getting. How do you go about finding these specific type of properties?
They're brokers that specialize this, and
Oh,
then we do have like direct to like one or two big developers that we do reach out every couple of months. Like our first property was my first property, but my partner's second or third. He got me into the affordable housing space. I wanted to do the value add. He actually bought something in 2018 and absolutely crushed it. And the more we talked about it, the more it just made sense for us to go that way. And he originally purchased from this developer, so we ended up really talking to the developer. The developer said, "Hey, this is a 50 unit. It's too small for us at this point." They're like the fourth or fifth biggest affordable housing developer in the country. So they were like, we're getting rid of this asset. This is kind of what we had in mind. We had this negotiation and we took it down. So a lot of it is just having that access to some of these affordable developers. Otherwise, there are a couple of brokers that just really specialize. And even a lot of the bigger a lot of the nationwide brokerages will have an affordable housing division, like the CBREs, the Marcus Millichets. They will have affordable housing division that only deals with LIHTC properties. And there's a couple of different versions of affordable housing. There's also USDA properties. There's also pure project-based voucher. So there's different segments as well of affordable housing, but it's very, very similar to regular value add thing. The same brokers, just different deal.
yeah, that makes sense. All right, man. Well, we have crushed the time here, so we are definitely into where we need to get into the quick question round. But I did want to hear about hospitality. You guys have a kind of unique model. So just tell me. I mean, we don't really have too much time to go into it, but tell me a little bit about it. You guys are. I mean, I'll let you go ahead and give the gist, but it sounded interesting.
Yeah, so the affordable stuff is cool because it's all out of state, and genuinely speaking, I do like the idea of driving to my own properties and seeing them. So when we did network with a couple of people locally, we live about 25 minutes from the Jersey Shore, so we started getting opportunities right in the Jersey Shore. And Jersey Shore is a very unique market. It is very, very expensive. Average home price in some of the areas that we look at are $1 to $2 million. But you get these grandfathered properties that are just outdated and tired. Same thing that you have with your outdated with your landlord that's owned it for 50 years and has no cost of capital. You see the exact same thing over here. So we're right now we're purchasing a 45 room motel with a 4-bedroom house on it. It is on the beach.
Oh,
But
nice.
Yeah, original owners, 50 years they've owned it. They live and breathe this property. They love it. And we're coming in and we're getting to kind of give it new life. So this is the second property that we've done. We have our own hospitality now management company, similar to how we did it with affordable. The partners that are involved on the hospitality side are not involved on the affordable housing because it's just such a different skill set. It's all about marketing and creating an experience. It's funny sometimes. Like I look at my team and I say, on the left side, the price per the month is what we get. On my right side's price for the night. So sometimes it's such a different clientele, but we honestly, I love working the two. And I think there's just world of potential. There's so much of these properties that you see it's they're too small. Like the acquisition we're doing is 8.5 million. It's too small for the big guys. Like you're not going to get a big hotel company coming in and taking it, and then it's too big for the guys who just started, has a duplex, triplex, because it's a legitimate business operating on that real estate side of it. So it's this beautiful little niche that we really really love, and the locations are sometimes like just amazing.
Nice, man. Well, we're gonna have to wait. We're gonna have to talk about that the next time you hop on the show. We're definitely it's a unique model, buying older hotel motels and turning them into kind of a boutique, something that you'd see on Airbnb. It's a unique model. I love the idea. But next time we'll go into it. This time we have run it down, and so it's time to jump into the quick question round. Are you ready?
Yeah, let's do it.
All right. It starts with education. It could be any form, could be a mentorship program you've been a part of, conference you've gone to, book you've read, anything. I need 2 recommendations, one for general life wisdom and then one for real estate.
General life wisdom, let's start with that one, is just surround yourself with the people that you could envision spending the people you want to model your life at. Like for example, my oldest kid plays travel soccer, and you get these conversations with these dads all the time. And there's the various of the dads of like the cliche guys who are like, still looking at, other, opposite sex, and they're making comments. And then you get the guys that are just the family guys who it's all about the family, and they do the right things, and those are the guys you want to emulate. So just surround yourself. Sometimes your childhood friends, they age out for a reason. You want to surround yourself with people that really, really want to be almost your role models. So that's general life. Real estate, almost similar. But I will do one piece of education is go to your local events. They have the RIAs and stuff, and then you get invited to other events. But just from an education perspective, you just want to actually take action from these events. I can't stress enough. Like there's this local meetup, and I go there, and there's very few people who are probably at my level at this point. But there's also the 2 or 3 really nice guys that I talk to, and sometimes like I cringe when I talk to them because they've been in the exact same place for like 3 years. And they've done nothing, like absolutely nothing. And like to them, the act of buying like one rental property is just so overwhelming that they can't get out of their own way. And every time I talk to them, and they're the nicest guys, they show up every single time. But that's not action. That's just the start of the action that you need to take.
Yeah, and I mean, that same sentiment has been echoed across many episodes, and whenever anybody says it, I always like to point it back to the listener. You guys, if you have been on the sidelines, you've been consuming educational content, figuring out what you're going to do, just take this as a kick in the pants and just go out and get a deal done. It doesn't matter what the deal is. It could be a small 1 bed 1 bath apartment, could be anything. You just need to get it done, and then that'll get the ball rolling. 10 years down the line, you're going to be happy that you did, because all it takes is action. Action is what will inform the next step. With that, I'm going to move us on to the next question. This is about the U.S. It's a big place. There is a lot of opportunity out there. Give me the single metro you're most excited about investing in today.
The Midwest. We are really big in Ohio, Northeast Ohio. We just closed on a deal last week on it, 45 units. We love the. We think it from a price point, we can get things between $60,000 to $80,000 a door for rents that are over $1,000. It works. Works really really well. And then the rest of the markets, we really look at the affordable stuff. But yeah, Midwest, Ohio. I stay away from the hot areas, the Texas, the Floridas, the Carolinas, the great areas. But it's
Spend it.
I like to be in areas where my property taxes are not going to triple
Yeah,
overnight,
that's
and
fair.
those
So
are the
in
areas.
Ohio, is there a specific area like Dayton, Cleveland?
Yeah,
Um,
so we're outside of Cleveland, so we're outside of like the North Canton, Stark, Portage County. Those are the counties. We really like Kent because we love the Kent State University. We like these markets that are not really talked about, and they don't have the double-digit population growth, but it's nice and steady, and the income works for those areas.
Perfect. All right, next question is about lessons learned. Not every deal we get into goes the way we expect it. In fact, pretty much every time something goes wrong, and that's when we get to learn a lesson. So take me back to a deal that went a little bit sideways for you guys, and then what was the lesson you pulled from it?
So I've invested in 3 Ponzi schemes, which is awesome. Yeah, yeah.
Wow.
That's as an LP, I've cut my thing, and I think the lesson is you really have to know the person you're partnering with, and even if you're an LP, you're still the word partners in it. Just really know who you're partnering with. If the returns are too good to be true, if they're guaranteed and they're fixed, and there's just so many red flags. If you see them on social media and they never say anything negative and it's just all positive, 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 there's just a lot of things to look out for. But don't get into investment and think you're going to have a perfect record. It just doesn't happen. You're going to have your misses. But I will tell
Especially
you,
when you're getting into like a new asset class. Every
yeah,
asset class you have to learn. And like for self-storage, I invested in this one area. I didn't realize how important, I mean, location is important across every asset, but for specifically for self-storage, if you invest in an area that is a little bit higher in property crime, you are going to be crushed by so many break-ins, and it's just something you don't really know until you've gone in, you've done a deal, and so you're gonna get hit in the face, and you just gotta you gotta take it as part of the education.
yeah. And I'll say, look, the highest ROI you're going to have is from those complete mistakes. And at the time, they are absolutely devastating. But later on, you are gonna make so many different decisions because of
Hmm.
what you went through. Like you're never gonna lose. So I am confident I could say this. I don't have many LP deals left, and I'm not gonna Ponzi scheme myself. I am pretty sure I will never get hit by another Ponzi scheme again. But at the same time, it's really like the learning lesson. And I've always talked to 2 different types of investors. One person who has shared my experience with Ponzi schemes and bad deals, and they're out of it. They're like, all right, I'm never doing this. I'm going back to the thing. And then I talked to the investor who really understood his lessons, really understood, owned it, and then the ROI going forward is infinite at that point.
Yeah. Yeah, it should never stop you. They are lessons, and they're valuable because you can take that, and going forward, you won't make that mistake again. Like for me, for self storage, I will not buy anything under 20,000 square feet because you can't. Well, even really under 30 or 40,000 square feet, because you can't hire on site management, and that is the lesson that I took from these smaller deals that I've done. And so, just because you made a mistake and you learned a hard lesson doesn't mean you should stop going forward in that particular direction. It's just a lesson. You just take the hit, and then you apply it to the next deals that you do. All right, I'm going to take that opportunity and move us on to the obverse of, or the opposite of that. So we talked about lessons learned. Let's talk about highlight reels. Sometimes you get into a deal, everything goes right, or almost everything goes right, and it kind of sticks in your brain as that special deal. So take us back to that one. Tell us what it was and how it went.
Yeah, so we recently purchased November 2024. We bought in Ravenna, which is Portage County, Ohio, 26 units, 1.45. We went in there, and we were able to basically, in less than 11 months, basically turn over 15 out of the 26 units, rent roll from 15,000 to 23,000. Basically, it's a full refi. We're just waiting for the prepayment penalty to go down. It's 3-2-1. So we're ready. So basically it's a fully executed business plan in less than 11 months. They usually don't go that well.
Yeah.
Sometimes you catch it. It was one of those where We put a camera system early on. We were really, really aggressive. So sometimes also a piece of advice for your listeners, pay attention to when a deal closes, especially if you're in, a 4-season environment. If you're looking at underwriting and you're looking at projections and that deal is closing in November and December, realistically speaking, the operator shouldn't be doing too much, shouldn't be evicting a lot of people in December, January, February. It's hard to lease up in those months. This deal specifically, what's amazing about it is basically in November, we started slowly kind of doing 1 or 2 evictions a month, but then we ramped up in March. And then basically from March to like May, and like a 3-month period, it went completely done. And it usually never works out that way. But as a piece of advice, pay attention to the winter month closings. And if you see a super aggressive year 1 and they're closing in the winter, good luck.
Yep, absolutely. All right, that leads us to the last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a 2-parter. Where can they find you, and then what can they expect when they reach out?
Yeah, the best way is sihcapitalgroup.com. Click learn more, or just contact me directly. My first name, DENIS, at sihcapitalgroup.com. We don't have an investor relations person. All the partners are in there. So you're going to talk to one of the partners that are involved on the deal. So just reach out, and I like establishing relationships. I don't think investors should invest day one. They should invest after they could really check off a lot of boxes that they feel like they know the person who they're investing with.
There you go. All right, I will put that link in the show notes. So if you guys want to reach out to Dennis, all you got to do is click the little more in the description. It's going to pull down that full description, and in there you can find his links. All right, man, that wraps it up. Thank you very much for hopping on the show.
Gabe, thanks for having me, man. That was awesome.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe, at therealestateinvestingclub.com. If you guys want to support the show, just leave us a review. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.